Hey guys, Chris from Spectrum Education. I just wanted to do a quick video and show you how we're going to set up the proxy portfolio of how you take all your portfolio of funds, mutual funds, stocks, everything, boil it down to two symbols, SPY and TLT, and then we're going to get ready to run that portfolio hedging process through a couple different time frames in the next few videos and look at how it performs. So here we go. So I've got Portfolio Visualizer up, and these are my model portfolios. I've got, again, we're using two symbols, SPY and TLT. Just a quick review. The SPY represents your entire equity portion of your mutual funds, ETFs, your whole entire investment portfolio. We break it down into equity and fixed income. We represent the equity by SPY, which is the S&P 500, and we represent the fixed income portion by TLT. So I've got three model portfolios here: 100% equity, 80-20 equity to fixed income, and 60-40. So we're going to analyze these portfolios and we're going to look at the drawdowns. Now I'm just looking at a very recent data here going back a few years, but I wanted to look first at this time frame from October 2018 through the end of the year and then on into about the first quarter. So this was a pretty significant drawdown. 1st of October until the end of December, this portfolio was down. The 80-20 was down about 10%, which is not terrible, but that's enough to kind of make you wake up and wish you didn't have that if there was a way around it. Okay, so we're going to look at an example, and I've outlined this in previous videos, but this is basically how we go about setting up your portfolio. So I'm going to use $100,000 because I'll show you why in a minute. Thinkorswim, that's the value for a mock account when you're looking back at prior data, and that's what we're going to do. We're going to back test the strategy. We're going to use the 80-20. Now, some people might be a little more aggressive than that. Some people might be, have more fixed income, but we're going to use 80% equity, 20% fixed income. So the total proportion that we need to hedge is 80,000. 80% times 100,000. So what we do is we look at the price of SPY on that particular date, which was October 1st, 2018. That's when we're starting this. That's $292. That's what it was trading, give or take a few cents. The TLT price was $117. So we take 80,000, divide it by 292, and that gives us basically 274 shares of SPY and 171 shares, I'm rounding, of TLT. All right, so here we are in Thinkorswim. What I have done is this is a real money account. That's the only way you can do this. You have real-time data, but you go over here and you click this on-demand button. When you click the on-demand button, you can go into the date here and go back to any date that you want to look at. And I've selected October 1st, 2018. So we are on October 1st, 2018. When you click it, it takes it a minute to kind of update everything. Here's our prices of our two symbols, SPY and TLT, and we've got 100,000. All right, what I'm going to do is I'm going to go in and I'm going to buy 274 shares, and I'm going to buy it at the market so I don't have to worry about a fill. 274 shares of SPY, and we just got filled. And if we look at that position, so we got filled. If we look at that position, we got 274 shares. The net liquidity, so the value of that is just over 80,000. Okay. Now we're going to go and we're going to buy. We're going to change this to TLT. We're going to buy 171 shares of TLT, and we'll do that at the market as well. And that one's not going to fill because I've got 19,000 in buying power, and I'm guessing it's rejected because I don't have enough buying power. So we're going to play around with it, and we're going to buy, I'll do 168 shares. Let's see if that works. Here we go. Okay, so I have two positions in this account. I've got SPY and I've got TLT. Now I've got 274 shares of SPY worth 80,188. I've got 168 shares of TLT worth 19,608. So there's my balance, 99,790. Okay. Now, what I'm going to do is assume that this is outside of this TD Ameritrade Thinkorswim account, because I've only got $215 worth of option buying power. I can't do any trades. I can't do any hedging. I can't sell anything. I can't do anything because I don't have any margin left because I've spent all my money. If I went in and I used a margin account, I could possibly do that, but that's not what I'm trying to do here. So what I'm going to do, I just wanted you to see how I did that, and I put these in there as filled orders for the proper amount of shares to basically create a proxy portfolio. So I'm assuming you've got, a $100,000 account with your neighborhood financial advisor, and it's maybe in American funds or Franklin Templeton funds or whatever. Well, you've gone through that process. You've got your statements. You've kind of collaborated all that data. You've come up with the 80-20. This is your model, your proxy portfolio, 80% SPY and 20% TLT. And that is our number of shares, 274. That's the number we need to know, 274 shares of SPY. You're not going to have this in real life, for real. What you're going to have are funds and ETFs and other stocks that equate or correlate to 274 shares of SPY. Okay, hope that makes sense and you understand that. So I'm going to go up here and I'm going to reset this account. We're going to stay on October 1st, 2008, but we've got 274 shares of SPY. So let's do it this way. Let's go ahead and just look at the SPY part. So I'm going to buy 274 shares. Let's do it at the market. All right, so now I'm only looking at the equity portion, which is 80,000. So if I look at my net liquidity here, I've got 80,191. But I'm not putting in the TLT part, so I've got $20,000 of option buying power. We're going to try it like this. It'll be easier to see the graphs with the SPY in here, but I'm also going to do it without it so you can kind of see what it looked like if you were trying to do this on your own outside of an account, which is probably the way most people are going to end up doing it. Okay, so here we are. We're going to look at the chart. The market is going along great. No problems. The volatility, that's what this chart is in the bottom. This is a chart of the implied volatility. If you don't know a lot about options yet, implied volatility is a measure of how expensive the options are. It's a calculation, and it fluctuates. So as options become more expensive, the IV, the implied volatility, is higher. When options become less expensive, the implied volatility is lower. It decreases. Well, as you can see, there's kind of a mean. Volatility spikes, and then it always kind of works back down to this average level, which is about, for the S&P 500, is about 15 or 16. Okay, so right here, the IV is like in the 11 or 12 range, so it's very, very low. That matters a lot with what strategies we're going to use. So when the implied volatility is low, options are less expensive, and that's actually kind of good from a hedging standpoint, but we're also going to sell options to help pay for that hedge, and I'm going to get into that here. So what we would do here is we're going to hedge this portfolio. Well, first let's go here and look at what we're looking at. So here is our P&L graph of the S&P 500. Here's our cost right here, and this is our break-even line. This is we're up 5,000. This is we're down 5,000. So when we're long stock or equities of any kind and there's no options involved, this is what our P&L looks like. It's just a straight line. There's no curvature to it. There's no change to it. It's just here we are. If the market goes up, we make money, which is reflected here. If the market goes down, we lose money. Very, very, very simple. Well, from our previous videos, what we want is we want to preserve this upside here, but we want to flatten this on the downside so we don't have this big risk here. Okay, this is risk. Anything below this line is losing money. Okay, so we want to chop this off and we want to turn this way. Well, traditionally, what you would do is you would buy a put to hedge this. Okay, guys, I'm going to stop this video here. This has been a really good setup. So in the next couple videos, we're going to get into step-by-step hedging this portfolio starting October 1st, 2018. And I'm going to go in and show you step by step exactly how we buy the puts, and then also how we place the income trades to offset the cost of the puts. And then we're going to look at how this performs in that time frame. So stay tuned. Thanks for joining in, and we'll see you next time.